the two biggest economies in the world, America and China, are now in a trade war.
And we're going to put away now from what is clearly a very hastily convened news conference with the Treasury Secretary Scott Bessent there, and you heard the voice of Caroline Levitt, the president's press secretary there. A couple of things really leap out of that. One is what I think you can pretty much hear, the relief in the voice of the Treasury Secretary there. Scott Bessent is one of those who was not in the camp of trying to tear up the global trading order, the globalization that's marked the last decades and has been so much to America's benefit. He was of those who say, look, let's do some deals, sure, and try and get a fairer deal, but don't demolish the global economic order in the process. And looking at Scott Bessent, he's got a lot of what he wanted there when just a short while ago, I suppose a couple of hours ago, that was very far from being clear. Another point that leapt out from there was Caroline Levitt's contribution, making the point that this is a victory for Donald Trump. No one's looking to China. What's she saying there? What's she really saying there? Clearly that the warnings about China being the geopolitical beneficiary of all of this, the idea that countries, and we've been talking about this on the program today, that countries on the wrong end of President Trump's tariffs would, in numbers around the world, they'd be looking towards China, some of them, and it would enhance China. So tough as this is for China, tough as it will continue to be for China, the concern was, in terms of spreading its influence and its power, this is also an opportunity. And we heard, I think, a recognition indirectly from President Trump's team of that fact too. So now we're going to talk now I think we've got a guest on the program now who can give us his thought on all of this, Gerard Lyons, who's Chief Economic Strategist at Netwealth, who's also on the board of the Bank of China UK. Gerard, welcome to you.
Good evening. Great to be on the show.
It's lovely to have you. So look, straight away, Gerard, your reaction to this breaking news?
Well, I think first and foremost, what's been announced is a positive development. It's not the best case scenario, which is a complete reversal of the tariff policy, but it's very much putting things on hold with respect to many countries for the moment. Obviously, we need to see more details, but I think it is important to stress that you've just touched on the politics in the US. What's been very evident, not just in the last few days, but particularly today, was the concerning nature of financial markets. We were almost moving to the next stage of an evolving financial crisis. Stock markets, which have already fallen across the world, were weak. And what we've seen particularly today is bond markets in America and also in the UK being hit hard. So when bond markets are hit against the backdrop of very weak stock markets, that's a cause for concern. And reinforcing that was a factor that many international investors were starting to become concerned about the safe haven nature of the dollar and of US bond markets and about how to trust future US economic policy. So I think in many respects, there's a political element clearly in the States, but there's no doubt that financial markets were sending a very clear signal to the US policymakers that the financial markets wanted to see a reversal or a resolution of the tariff policy, and also ideally wanted to see some stimulatory measures to offset the current weakness and potential weakness of the US economy.
Yes.
But in terms of the actual tariff policy, the fact that there is a pause, but as I say, we need to see the full details. It doesn't remove all the problems. Let's stress that. But for the moment, let me just leave it there. It's a positive development, and markets will naturally reflect that. And there will likely be a significant reaction, not just this evening in the States, but probably overnight in Asian markets and tomorrow into the UK and European markets as well.
And have we entered a period of something? Well, I mean, nothing, anything would be comparative stability compared to what we've been seeing over recent days. But is this now going to be a period of well, maybe significant stability over a more prolonged period? And as you say, Gerard, I mean, Scott Bessent a moment ago was asked directly the question, is this about the turmoil in the market? He says, no, nothing to do with that. Well, hollow laugh at that. But of course, one will believe it has everything to do with the turmoil in the markets. And even though Donald Trump is famous for his sensitivity to the movement of markets, very keen to take credit. I can recall a huge press conference in the Rose Garden after one significant move upwards in the New York Stock Exchange. Yeah. He said he wasn't concerned about that, but, he clearly is. He watches the markets like a hawk, and those around him more so. Scott Bessent is a Wall Street veteran. He'll have been very much, isn't it? And he'll have the numbers to back it up. Now, as for where we are now, you say it's not clearly, universally good news, Gerard. We still got the 10% tariff in place. That is there during this 90-day pause. But listening again to Bessent just a moment ago, he seems to see this as the beginning and not the end of a winding down process, doesn't he? He's talking about the world leaders. He says are queuing up. We've now heard the number of 75 of them who are looking for deals. Well, clearly, the Treasury Secretary is urging them on. He's hoping for a significant lessening of this tariff war over these 90 days.
Okay, well, let's be quite clear. What we still have in place is that globalization has been replaced in recent years, and particularly now, by fragmentation. And that still has to work its way through.
Yeah.
Free trade has been replaced by a move towards protectionism.
Yeah.
And reinforcing that is geopolitics is now intertwined with economics. Now, even though we're talking about the positive aspect, which is still nonetheless 10% tariffs across the board for all countries, as far as I can understand it, dealing with America. But there, as I say, we need to see the full details. But even so, the two biggest economies in the world, America and China, are now in a trade war. That is globally significant. Even though China's dependence on the US is less than it used to be, the reality is that both of these countries are heavily intertwined. At the same time, a quarter of US treasuries, quarter of US government debt is owned by international investors.
Yeah.
And the Chinese in particular own a significant proportion. So the two countries are intertwined. They're in a trade war. Now, one hopes that that is resolved.
Yes.
And at the same time, what we've seen in recent weeks is clarity being replaced by uncertainty when it comes to US economic policy.
Yes.
We still have uncertainty there. Now, that might not mean that international investors are going to continue to do what they've done in the last few days.
Yeah.
But it still means that many international investors will now think twice about the future safe haven status of the dollar and of US assets.
Yes. Yeah.
What President Trump has clearly instilled now is uncertainty and unpredictability into US economic policy.
Yes.
And while it's good that there's been some reversal and some resolution, that uncertainty is not removed. And we are also still not in a situation of zero tariffs. And there is still a lack of clarity in my mind as to how we move from here. So it's better than it was,
yes,
but it's not ideal.
Yeah, I mean, look, we've moved into a period of uncertainty, as you say, so many questions on where we go from here, but it seems to have replaced a situation of something like meltdown. And that
absolutely, that's very positive. Sorry, yeah, I completely agree with you on that. We were going to the next stage of an evolving financial crisis that threatened to become a global economic crisis. And I think the signals from the market have been heeded and taken on board, or that's my read of it in terms of the US.
Okay, I've got with me here Mikey Smith from The Mirror and Kate Ferguson from The Sun on Sunday. Gerard, we're keen to sort of turn this into a, I suppose, what do we call it? A think-a-thon. What on earth is going to happen from here? And Sarah Baxter with us on the other side of the pond. But Kate.
Gerard, can I ask you a question?
Yes, certainly.
Thanks. You talk about, so we know, don't we, that these big tariffs are still staying with China. So it looks like this trade war, as you alluded to, between America and China is here to stay, at least for now. What does that mean for Britain, for British consumers? Like, for my reader, what does that mean? It's bad news economically, but why?
Okay, there's two aspects. First, there's the direct impact that we've talked about in terms of the US and tariffs, and the fact that in the last week we weren't hit as badly as everyone else. But your question is about what everyone has called the next stage, the follow-up. And the point is this, that Britain is a very large open economy. We're the fifth or sixth biggest economy in the world, depending on which figures you use. And we're heavily interlinked in the global economic system. if there's a trade war between the two biggest economies in the world, that tends not to just impact those two economies, but it has ramifications in terms of other countries that they interact with. Because what we know from history, from economic theory, and also from economic forecasting models, which admittedly influenced by the past, that when it comes to tariffs, tariffs is one of these bizarre areas where usually good economics is good politics, but tariffs is one of those situations where politics and economics pull apart. So the economics suggests you don't impose tariffs, and the economics suggests you don't react with retaliatory tariffs. But the politics clearly in America and China suggest otherwise. So when countries go down the route of a trade war, it tends to, we know from history and theory and the models, that it tends to impact both those countries, impacts their their prices, impacts their spending behavior, and it permeates into trade.
Yeah.
Now, if it was just two very small countries, then it would be different. Now, tariffs have been around for a long time. At the end of last year, for instance, the European Union imposed tariffs on Chinese electric vehicles. So sometimes regions and countries impose tariffs on each other, which are very specific. What we have here is something that's much broader and much wider. And so what catches us out, coming back to your question in the UK, is the indirect impact, how it impacts and permeates through the global trading system.
Yes. Yeah, and look, and a further question on that. And again, just to be very clear, that after all of this, comparative calm on the markets, and how could it be less calm than it has been in recent days? We still have 10% tariffs in place, which is exactly in the case of the United Kingdom where we were an hour ago, a day ago. I mean, days ago, and that number, Gerard, that was more than enough to cause, well, not just concern, but the certainty of a knock to British numbers, public finance numbers. The rate of economic growth was going to take a hit, and as things stand, are still going to take a hit. And the concerns are facing the Chancellor, Rachel Reeves. Where does she go from here in her spending numbers?
I think that's correct.
Yeah, I mean, spending numbers in a few weeks, and then the spending review after that. Those problems are unchanged by all of this. The task is as great as it was, Gerard.
That's right. A couple of weeks ago, we had the spring statement, and the independent forecaster, the OBR, revised down its growth forecast for this year, but revised up its growth forecast for future years. But the Chancellor has these self-imposed fiscal rules, which don't give her much room for manoeuvre. Now, the OBR did 3 scenarios based on tariff policy, and on each of those, the UK economy was impacted in different ways. Now, we still need to see how things evolve here. But the UK economy is sort of recovering in some respects, growing at a modest pace, but is not resilient enough to global events. But more particularly, when it comes to the government finances, it's almost like being in a hole and digging deeper. If the economy weakens or is hit by an external shock, what you ideally want is the Bank of England to cut interest rates, and they probably still will. But you want the Chancellor, through her fiscal policy, which is government spending and taxation, to ideally help the economy out. Well, we have this back-to-front policy situation where if the economic growth outlook becomes weaker, then because of the fiscal rules, that means the Chancellor has less room for manoeuvre. And therefore, based on those rules, she either borrows more, raises taxes, or cuts spending, or a combination of those. Ideally, what we would like is, if we have this situation causing uncertainty, then the Chancellor ideally should say, look, I'm committed to keeping fiscal policy sound, but I'm not going to be bound by these self-imposed fiscal rules for the moment. Let's have a bit of clarity externally. But the problem is, if you allow these rules to cause you to tighten policy, then you do the opposite of what you ideally need to be doing. So it's a self-imposed problem. On the positive, there is still scope for the Bank of England to ease rates. The markets ahead of this evening's announcement were factoring in 3 rate cuts, one in May, one in August, and another one before the end of the year. So Bank of England interest rates are now 4.5%. This afternoon, the markets were thinking rates would be down at 3.75 by the end of the year. The markets might change their expectations, but they will still expect, and I think they'll be correct, to expect rates in the UK to be down to at least 4% by the end of the year.
And just really, really briefly, maybe a cloud behind the silver lining. If all of rates outside China are level at 10%, then there was something of a competitive advantage for the United Kingdom in world markets. That now goes away.
Yes, that's right. We're clutching at straws when you have a backdrop of
you've got to do that
high
occasionally.
tariffs. But you're right. But I think it comes back to we're pleased at the moment from our discussion because things were better than they were before and they could have deteriorated further. So this pause is welcome news, but the uncertainty prevails. And it's still worrying when you have the world's two biggest economies loggerheads with each other because it's unclear how that will fully play out.
All right, good to get your thoughts, Gerard. Thank you so much, Gerard Lyons. There, the chief economic strategist at Netwealth.